Hello there. It's often said that the four most dangerous words in investing are "this time it's different." Now, I started my financial career during the dot-com bubble or the tech bubble of the late 90s, and I vividly remember there people were saying that things are very different now in the internet age. You know, there's a new paradigm that we don't need to worry so much about company earnings or valuations or any of those things. It's all changed. And of course we know what happened next, that the bubble burst, and actually I saw lots of people lose lots of money in that kind of environment. Turns out actually companies do need to make money, they do need to make profits and see them grow over time if you're going to be worth investing in their shares. So I've always remembered that quote, which is why we've often used it in some of our publications and things in the past, because it really resonates with me. And so every time we see something that's a little bit new, a little bit different, we're always asking that question: is it really different this time, or actually is it just something else that we need to understand? But we are getting lots of those questions at the moment, because what we are seeing at the moment is a little bit of a different relationship between some of the things in the economy that we would normally expect to see, the interest rates, inflation, and the global economic growth we tend to see are very well correlated with each other. Normally, for example, you get inflation because the economy is running too hot. Central banks therefore put up interest rates in order to slow down the economy, and then that slows the inflation, and that's how things tend to work. But things have been slightly unusual this year, because interest rates have carried on rising this year, perhaps more than a lot of people have expected. But the economy has actually done better than everybody expected. It's not doing brilliantly well, but it's still growing for now. Still a bit worried it could turn down later in the year. But at the moment, it's still doing better than expected. But inflation has also proved a bit stickier. It's starting to come down, but again, particularly here in the UK, it's taking longer to come down than people have expected. So therefore, the question then to be asked is whether that relationship has broken down. I don't believe it has. But in the investment market, we're seeing something similar, where, for example, we would normally expect to see, if interest rates are carry on rising as they are, technology stocks, we'd normally expect to see them do poorly, as they did last year when rates were going up so much. They tend to be quite interest rate sensitive. But so far this year, they've actually done a lot better than you would normally have expected. Perhaps again, it's that new paradigm that is artificial intelligence, and lots of people thinking that might change everything in the future. So, but what is different? What has changed? Why are those relationships slightly different at the moment? Well, we think it's actually all back to what happened during the pandemic. During the pandemic, we were much more worried about deflation. We were worried about people losing jobs and obviously people losing lives. Central banks and governments did a massive amount of stimulus there. So central banks did quantitative easing, cut interest rates to zero, and governments pumped lots of money into the system in other ways. In the UK, we had furlough scheme, for example. In the US, they literally sent everybody a check in the post. And we still believe that the inflation we're seeing today is fundamentally caused by that massive amount of stimulus. With hindsight, you can kind of say it was too much stimulus, more than we needed. But of course, at the time, we didn't know that. It was certainly right, I think, for the authorities to err on the side of too much rather than too little. And of course, vaccines came along much quicker than lots of people anticipated, and therefore we recovered more quickly. But I still think all of that money pumped into the system is why we're seeing those sort of strange relationships at the moment, why we're still seeing inflation, why interest rates aren't having the impact that we would normally see, because essentially there's still a lot of money sloshing around there. Lots of people have got excess savings and all those sorts of things. So I don't think there's anything different or fundamentally changed about the way the economy works. It's just that we're dealing with a very unusual event still, which was the global pandemic. So we still think fundamentally that as that effect of that stimulus will eventually wane, that things will reassert themselves and go back to normal. Inflation should gradually come down. But one thing we've often talked about and people have worried about is whether we might see a little bit more ingrained inflation, perhaps because wages start going up and therefore people have more money to spend, and therefore that causes wage prices inflation, and we get this kind of spiral that lots of people remember from the 1970s. Until now, we've always said that's not been an issue. Whilst wages have been rising, generally they're below inflation. But what we are starting to see now is some good news in the wage front. People are seeing their salaries grow, and we're seeing inflation come down. And right now, for the first time in a couple of years, we actually are starting to see people getting real wage increases after inflation, which is obviously a positive in lots of ways, but it's also could lead to inflation becoming more persistent. Now, this is the first time, as I say, in a couple of years that we've seen positive real wage growth. You would need to see that persist for a long time before you might be seeing that sort of inflation spiral. But it is just something we just have to bear in mind. And as a result, we've just put a few more things in the portfolio recently that ought to provide us some inflation protection, such as some inflation-linked bonds, for example. But again, we fundamentally think inflation's obviously always the thing that we need to worry about with our savings. It erodes the value of our savings over time, and the only way we can kind of try and deal with that is to invest. And investing over the long term has been shown to be one of the best ways of keeping your money growing ahead of inflation. So I hope you found that useful, and thanks a lot. See you next time.